Hey, it's Tom here and welcome back to the channel. Now, Charlie Munger is one of the GOAT investors. Not that kind of GOAT, more like the greatest of all time kind of GOAT. And one of my personal favorite quotes from Charlie Munger is, "To a man with a hammer, every problem looks like a nail." Now, when it comes to investing in great businesses, we're likely to encounter many different problems that we're going to need to solve. And unfortunately for the guy with a hammer, not every single problem is going to be a nail. And we really need to have a pretty wide range of mental tools in our kind of mental toolbox in order to solve these different problems. And Charlie Munger calls that a latticework of mental models. It's a kind of network of different ideas, different mental models, as he calls them, that can work together in order to apply the right idea to the right kind of problem and solve these different problems and analyze companies very efficiently and very effectively. And over the years, Charlie Munger has talked about how he has basically expanded his own latticework of mental models to include hundreds of mental models at this point, include hundreds of different ideas that help him to analyze little nuances within different businesses and different investment opportunities. But he also says that really the bulk of the heavy lifting when it comes to analyzing different problems and using your latticework of mental models in order to work through an investment case, a lot of the heavy lifting is really only done by a handful of different ideas. And I've kind of experienced the same thing. Now, I don't want to be the man with a hammer thinking every problem looks like a nail, so I'm trying to constantly learn new ideas and study different types of businesses in order to grow this latticework of mental models. But even so, I have still found myself kind of coming back to a handful of key ideas. And to use another Charlie Munger quote, he often says, "Take a simple idea and take it seriously." And this handful of mental models that I often find myself coming back to are really not that complicated. They're quite simple ideas, but they're powerful ideas. Investing really doesn't have to be super complicated. And in this video, I basically want to share 5 of my most commonly used, fairly simple mental models that I kind of always find myself coming back to. Now, if you've got your own fairly straightforward mental models that you also find yourself coming back to quite often, definitely drop those down in the comments below. I would be super interested to see those and add them to my own lattice work if I haven't already got them in there. But for now, I will just want to go through some of the simple ideas and the simple mental models that I keep coming back to and I continue to find very, very useful. Now, the first mental model I am always coming back to and I just use constantly is the rule of 72. And if you've been a very long time follower of the YouTube channel, you'll even know that my very first YouTube video was on the rule of 72. Now, please don't go back and watch that video, it's terrible, but I leave it up there because it is what it is. And even since uploading that video back in, I think, late 2018, around October 2018 at this point, I still find myself using the rule of 72 all the time. And the rule of 72 is basically a way of quickly estimating rates of compounded growth. So for whatever reason, the human mind really struggles to calculate or think about things that grow or shrink exponentially. We're pretty good at kind of linear styles of maths. So if I asked you, what's 10 times 10, you'd probably tell me 100, hopefully. That's a fairly easy calculation to do. But if I told you, an amount of money has doubled in 5 years, what's the annual growth rate compounded of that money? That's a more difficult calculation to do in your head. And the rule of 72 is quite a kind of quick and dirty way to solve that problem. So the way the rule of 72 works, and don't ask me why it's 72, it just kind of works. I accept it for what it is and just use it as a tool, is you take the number 72 and you divide it by either a compounded growth rate or a number of years. Depending on which one you use will kind of decide which answer you get. So if you divide 72 by a number of years, you will get a compounded growth rate as your answer, or if you divide 72 by a compounded growth rate, you will get a number of years as your answer. So for example, if we take that amount of money that has doubled in 5 years and want to figure out the growth rate, we take 72, we divide it by 5, which is the number of years that it took for, that amount of money to double, and we get approximately 15. So that tells me that about 15% per year compounded gives you a double every 5 years. And I use this kind of maths all the time when looking at companies as well. So let's say, for example, a company has grown its earnings from $1 per share to $8 per share over 10 years. Now, the first thing we need to do is basically work backwards and figure out how many doubles that is. So if you've got 8, cut it in half is 4, cut it in half again is 2, and cut it in half again and you get back to 1. So to go from 1 to 8, you're basically doubling over and over 3 times. So if you've doubled 3 times in 10 years, let's just make the math simpler and say you've doubled 3 times in 9 years, that means you're doubling every 3 years. And if you use the rule of 72, you can then say 72 divided by 3 years per double gets you about 24-25% per year. Now, the rule of 72, of course, isn't exact, but it is super helpful, and at the end of the day, I'm trying to be directionally right. I'm not trying to calculate things out to 5 decimal places or anything crazy like that, so a rule like the rule of 72 is one that I come back to all the time. Now, the next mental model I want to talk about is actually one I got from Monish Pabrai, and that is this very simple mental model of compound 26. Now, compound 26 was actually Monish Pabrai's number plate at one point in time. I believe it actually is rule of 72 now, so Monish Pabrai is clearly a fan of these first couple of mental models. Now, compound 26 is basically Monish Pabrai's entire investment strategy, at least it was until in the last year or so. And basically, compound 26 is the doubling of your money every 3 years. So the rule of 72 divided by 3 gets us about 24. And in actual fact, the number is about 26%. So like I say, the rule of 72 does just get us like a ballpark figure, but we're in the right ballpark. Now, compound 26, doubling every 3 years, like I say, was basically Monish Pabrai's investment strategy. And the way that he effectively approached that was to try and buy $1 of value for a price of 50 cents. And if he was able to buy $1 of value for a price of 50 cents, by assessing the intrinsic value of the company and buying businesses substantially below their intrinsic value, if it took about 3 years for that value to appreciate back up to where it should be, so if it went from 50 cents back up to $1 and that took 3 years, that works out at a compound annual growth rate of 26% per year. And 26% per year returns are really freaking good. If you can do that for a long period of time, you will be a very wealthy individual, even starting with very small sums of money. So that was kind of Monish Pabrai's initial goal. Of course, you mix in some mistakes, and some things take a bit longer to appreciate to $1 and so on, and that kind of pulls down your rate of return a little bit. But nonetheless, if you can, shoot for 26 and land on 18 or something, that's still substantially better than almost any investor on the planet over a long period of time. Now, getting maybe a little bit more into sort of the practical application of making investments, the third mental model I want to talk about is a short-term event. Now, a short-term event, as the name suggests, is basically where a company goes through some sort of short-term issues, and by short-term I mean anywhere from probably 1 to 3 years. And they're basically going to come out the other side of that short-term event completely fine. They're going to come out the other side relatively unscathed and kind of return to the normal course of business. Now, when I look back at my portfolio historically, this has been basically the catalyst for me to get invested in very close to every company I've ever invested in. There's always some sort of event that I view as short-term at the time. Now, there have been exceptions to that, and there's companies I've invested in where there's no obvious event. I just think it's genuinely undervalued. But events are often a very common cause of a business trading at a discount to intrinsic value. And basically the reason for that is most market participants are very short-term focused. I just described a short-term event as 1 to 3 years. A lot of the participants in the market are benchmarking themselves in their professional career and money management on a quarterly basis. So if something's going to have a problem for 1 to 3 years, that is way too long a time for oftentimes professional investors to wait around and stay invested in that company. And for that reason, investors like you and me get the opportunity to buy into really good businesses when they're going through a little bit of short-term pain and basically no one else wants to own them. And often when no one wants to own a business, we can buy it really cheaply. And a couple of years down the track, once they've sorted out all the issues and all that, professional money flows back into it for the next quarterly benchmark, the price can sort of re-rate upwards and we can do very, very well in those investments. And kind of relating it back to the previous mental model of compound 26, that's really how a lot of those potential investments can turn up in the first place, is there's some sort of short-term problem going on, and it's a great way for us to earn very high rates of return. Now, the next mental model I find myself coming back to all the time is the concept of margin of safety. And margin of safety is an idea first presented by Ben Graham, Warren Buffett's teacher, the dean of value investing as he was called. And it's basically describes buying something for less than it's worth. So like I've mentioned in a couple of these previous mental models, we try to assess the intrinsic value of a business. If we can buy it for substantially less than that intrinsic value, we can set ourselves up to do pretty well in investing. And having that margin of safety has kind of two main benefits. So the first benefit is if you buy something for substantially less than it's worth, the chances of you experiencing a permanent loss of capital in that investment are more muted than they would be if you had paid a really, really high price for a company. So for example, if you can buy into a real estate company and that real estate company has $1 million in assets, after backing out the debt, and you can buy into that real estate company for $300,000, the chances of you losing money over a long period of time are relatively slim. Now, of course, the price in the market can do all sorts of things, and that's why we even get the opportunity to buy these things sometimes. But the chances of the price staying depressed for an extended period of time, if you are correct in your analysis of the true value of those assets, is pretty unlikely. And of course, the major benefit to buying with a margin of safety is if the price does re-rate back up to what it really should be worth, you get to make a really high return. You get this nice asymmetric bet where you've got relatively muted downside, you've got really good upside, and those are the bets that value investors like to take all day long. Now, the fifth and final mental model that I want to talk about is another Mohnish Pabrai one. This comes really straight from the Dando Investor, his book, which I highly recommend reading it if you haven't already. And this is that idea of risk versus uncertainty. And markets really often getting confused between the two. Now, people will often use those words interchangeably. They'll sometimes describe uncertainty as risk and risk as uncertainty. And a lot of people really don't know the difference in an investment context. But for a long-term value investor, there really are distinct differences. And risk, I would describe, and this is just me cloning Mohnish Pabrai here, I would describe as the chances of a permanent loss of capital. So if I put $1 into this investment, what are the chances that I'm going to take substantially less than $1 out of that investment? That is risk. Will I lose money? Now, uncertainty, on the other hand, is simply a wide range of potential outcomes. And in some cases, risk and uncertainty do go together. There may be a high chance of losing money, and there might be a very wide range of potential possibilities. So maybe you lose a lot of money, maybe you make a little bit of money, maybe you make a lot of money, nobody really knows. But the situations that Mohnish Pabrai likes to get himself into where risk is low and uncertainty is high. So if uncertainty is high, that generally scares a lot of people away from a stock, just like we were talking about with events-based investing before. But if the risk is low, it really provides a great buying opportunity for investors. And there's countless investment examples from Pabrai specifically where he's got himself into a situation with low risk and high uncertainty. IPSCO is a very famous one, an investment in a steel company which was basically going to have earnings equivalent to its market cap over the next couple of years. But what happened after year 2 or 3 was very uncertain, and that kind of scared a lot of market participants away. You've got a business like Seritage Growth Properties as well, which Pabrai invested in last year during the early stages of the pandemic, and he was able to buy into a real estate company that was going through this redevelopment phase, but also having a lot of short-term headwinds from the early stages of the pandemic, and he was able to buy into a real estate company for substantially below its liquidation value. So there are a few of my favorite mental models that I find myself pretty consistently coming back to. It's an idea that I first picked up from Charlie Munger, and this Latticework of mental models up in my head, something I really want to continue expanding, but hopefully these ones are a pretty good start for anyone trying to kick off that project themselves. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.